Welcome, everyone. My name is Brendan Delandria, and I have the honor of serving Upper Canada College as Vice Principal of Advancement. It's my great pleasure to welcome you all to today's Speaking of Cryptocurrency, our first in a new virtual event series relating to current trends, emerging topics, and global perspectives. This event features several experts from our community. And today they will be exploring the foundations of blockchain technology, explaining how crypto is transforming finance and culture, and give us a glimpse into what's on the horizon for decentralized finance, NFTs, and DAOs. You're going to hear from three remarkable alumni today, and we are truly grateful to them for taking time out of their busy schedules to be a part of this event. Their dedication and commitment to UCC exemplifies the nature of our alumni community, and I can't wait to hear what each of them has to say. Before we get started, just a few quick housekeeping notes. Thank you for joining us today on Zoom, and for those of you who are camera on, it's wonderful to see you. We encourage everyone to turn their cameras on if they feel comfortable. It's a nice way to feel a part of this incredible community here at Upper Canada College. We do ask, if you will, please stay muted for the beginning of the event, and we'll have an opportunity for questions later on as the event unfolds. To that end, please feel free to post any questions through the chat function of Zoom at any time, and our moderator will take the opportunity to pose those questions to our panelists at the end of the event. And to help us identify you, if you would like, please feel free to change your screen name on Zoom to include your full name and class year if you are indeed a graduate of the college. And with that, I'm very honored to introduce our moderator. David Cash will be providing the honor today of facilitating this conversation, bringing a wealth of knowledge and experience in the cryptocurrency space, specifically with NFTs and blockchain technology. And if you don't know what those words refer to yet, don't worry, you're about to find out over the next hour. David is a UCC graduate, class of 2015, and launched Cash Labs recently with over 6 years of commercial photo video production experience. Their work has been seen internationally in outlets ranging from Vogue to MTV and to Netflix. And this professional experience, paired with having written a master's thesis on the topic of NFTs and DeFi, makes Cash and their team uniquely qualified to produce the highest quality NFTs on the market. Cash is currently the lead curator of Decentraland's Metaverse Fashion Week, a metaverse editor for Vogue Singapore, the editor-in-chief of NFTs WTF by Outlier Ventures, and an advisor for many of the top organizations and artists in the NFT Web3 space. Without further ado, it's my pleasure to introduce David Cash. David, over to you, please.
Awesome. Thank you so much, Brendan. It's an honor to be part of this event and share my experience and enthusiasm for NFTs and crypto and this crypto world. So my background in this space is a little bit interesting. As you mentioned, I ran a production company for the better part of 6 years during my undergrad and before my master's. And things were going well. I was definitely always interested in crypto. I invested in Bitcoin back in 2014, more of a passion project. And when I was just, very interested in new media, I was always, working in fringe types of video and VR and 360 cameras. And so I actually minted my first NFT back in 2019 when they weren't even called NFTs yet. So we're going to get into those details during this conversation. But my official business start, I would say, in this world of Web3 and NFTs and crypto came about during COVID. So I was working through my production company, doing primarily on-set work, going to gigs, and all of a sudden, all of that went away and I wasn't able to do that. So I decided to go back to school. I did a master's degree. I actually went over to Italy to do that master's degree at a school called Polymota. And our final thesis was very open-ended. And this was at the end of 2020. Last year, or the year before last, feels like last year. And yeah, this was kind of the perfect opportunity for me to start researching NFTs and DeFi on a deeper level. And I spent, the extent of my master's really going as in-depth as possible within that world. And that resulted in me, releasing my thesis. I took a version of it and I released it for free on the internet because that's very much the spirit of Web3. We share information freely here and allow everybody to be their own, sovereign being. And that's really the goal here in this space. And yeah, that very much took off. That got me a bunch of writing jobs, and then those led to editing jobs, and that led to me consulting for people in the space. We got to do a bunch of awesome drops. My studio did the first ever drop for the NBA with the Utah Jazz. We did the first drop for French Montana and his team. We did a takeover of Art Basel this past December that was featured in the New York Times and Hypebeast and a bunch of other magazines. So it's been a really amazing climb, I suppose, over the past year or so. And this space has been a really amazing catalyst to kind of do whatever I want to creatively. So I've been really honored to, be a part of this space and move forwards. And speaking of people who are, moving things forward in the space, I'm also joined today with two incredible old boys. John Lister, class of '09. John is, like I said, from the class of '09 and is the co-founder and president of Sat Street, one of Canada's fastest growing digital asset brokerages. John previously co-founded Block EQ, a leading platform for the Stellar Network, and also gained experience at BMO Capital Markets and Blackhawk Network. And in addition, John also earned his honors Bachelor of Arts at Ivy Business School. So maybe something that a bunch of people here are checking out. And then last but not least, of course, we're also joined with Colin Gaffney, class of '08. And this past summer, he moved to LA to work on the credit team at Tala, a startup giving small uncollateralized loans to customers in emerging markets. He studied engineering at McGill and worked in the insurance and mining industries before taking his MBA at U of T. Now, hopefully my Roomba in the other room is not distracting anybody. I might be the only one who can hear it. But with all that said, let's dive right in. As Brendan mentioned, please feel free to ask questions along the way. We're looking forward to hearing everyone from the audience and your questions. So without further ado, Colin and John, before we get into the formal presentation about all things crypto, let's start off by briefly sharing your connection to the crypto space. So where did your interest start and what was your journey? We can start with John and then move it over to Colin.
Thanks, David. So yeah, I started getting into the space. It was really a close friend of mine asked, what I thought about Bitcoin. This was about 6 to 7 years ago. And rather than recite the headlines of Bitcoin being only used by drug dealers and money launderers, I decided to do some research and give them my real, thoughts. So I started reading a few articles, watching a few lectures, and then I think 2 weeks went by and I'd only consumed crypto content. So I fell down the rabbit hole and really never came out. Ended up starting a company in early 2018, which sold to CoinSquare, one of the largest exchanges at the time. Since then, co-founded Sat Street, and recently just passed a total of $750 million of trades for clients across Canada. So we're really excited to pass $1 billion in total trades this year. We're on a great track, and that's just for clients across Canada, whether they're high net worth or corporations looking to buy, sell, or trade digital assets. So I'm excited to share some things I've learned over the years and try to boil down the complexity to make it easier to understand.
Awesome. Yeah, for my intro, how I came involved with crypto was kind of similar to David, where I was taking my MBA to move away from insurance and trying to look for something. I was diving into a lot of different areas in fintech, and there I was kind of reminded about crypto at a time in early 2020, when crypto was still kind of in the coming out the other end of a crypto winter. And I started looking into, okay, there's actually some use cases here. It could be used in trade finance, and there's basically trying to take away some of the ideas that I had about it being for scams and everything as well. And then in 2020, I started doing some consulting work, doing some operations work and user analytics for a crypto payment startup, and then kind of diving full-time into the space for a while before now it's become kind of my full-time, part-time job as I moved down to LA, and I'm doing some part-time work with some decentralized organizations and other parts of the crypto space, and keeping that interest going while I work at Tala, which they use. They actually a tie to John's background. The Stellar Foundation is one of their main investors, because there's a lot that they could do to change the back end, kind of the rails of how they transfer money between countries and support the loans on a local basis, but it's not in the forefront of their business model just yet.
Awesome. Awesome. Thank you both. I think it's really important that we share our journeys and how we got to where we are today, especially considering how early we are in this space. And I know a lot of people are interested in, seeing what this is all about and potentially getting in. So as everybody who's listening or watching can see, all of our paths are different and unique, and getting to where we are was certainly not a straight line. With that, John and Colin are going to share a presentation on the basics of what is cryptocurrency, why use it, what are the different types of cryptocurrency technology, and the groundbreaking technological innovations that have come from the crypto space. After which I'll touch upon NFTs, the future of DAOs, and talking a little bit about what exactly the metaverse is, which is very much a buzzword right now. So without further ado, I'm going to share my screen and let Colin and John take it away with their presentation. So ignore that, and hopefully you can all see this.
Awesome. Thanks, David. If you want to jump 2 slides. So I think it's good to start by just simply understanding the why to cryptocurrency. And I think we can do that by really looking at the problem that it solves. So over the past 2 years, I think it's been very clear to see that there's a bit of a problem with the levels of debt countries are accumulating around the world. And we can see this in the debt to GDP ratios now exceeding well over 100%. So the larger this debt grows, the greater the pressure is for monetary debasement. New currency has to be issued in order to service the debt and continue high spending levels. This in turn causes a problem with inflation. We've seen this in housing prices, tuition costs. And although we may hear numbers like 6 to 7% inflation, if we measured inflation the way it was actually calculated in 1980, we would actually be having inflation in the 15 to 20% range. So this is a bit of an issue if you're simply holding dollars in a bank account, your hard-earned savings. You're paying a tax on, your salary and when you buy goods. And now when you have idle dollars sitting in an account that's earning, a measly sub 1% interest, you're losing money to inflation. Your purchasing power is decreasing. But, there's a solution. And so how would we go about solving this? So as a fun thought experiment, what if UCC as a community was to issue a coin? We call it UCC coin or Ucoin to be more globally branded. And what if we start thinking about how we could go about designing this to maximize its chance of success? So rather than having one server in UCC's basement that controls the whole network and maintains the ledger of every account and knows exactly where all the currencies are, we need to have a system that isn't vulnerable to a single point of failure. So let's say with, we need a supply cap to issue the problem of monetary debasement. Let's come up with a cap of, let's say, 2.1 quadrillion units. That should be divisible enough that it can be widely circulated and everyone can use it for transactions. And we need to, rather than starting with all the currency issued from day one, what if we started with a supply of 0 and over time slowly issued the currency to the network? And since we want more than one server to run and control the network, what if we incentivize people around the world to maintain a copy of this ledger and enforce the rules of the network so it's distributed and decentralized? In order to do that, they need some sort of incentive. Now, we could raise a bunch of money by selling this token to investors, and then we have capital to pay people to run servers and pay people a marketing budget, but that presents a bit of an issue. Raising money through a token sale can bring in regulations by selling to potentially retail investors, and it brings the risk of issuing an illegal security. So we don't really want to do a token sale approach, but what if people could earn this token over time? So what if by hosting, servers at your house or in a data facility, you could be rewarded by this coin over time. So let's say every 10 minutes, we issue 5 billion of these units. And over time, we could reduce that reward as we approach this supply cap of 2.1 quadrillion units. So it kind of decreases on a logarithmic scale. This kind of provides an incentive for early adopters to get into the network early, and then over time, it becomes more and more scarce. So this solution was actually proposed in October 31st of 2008 by an individual named Satoshi Nakamoto in the Bitcoin white paper. And sorry, next slide. So what this white paper solved was this problem of a single point of failure with having a centralized server. It wanted to have a distributed ledger that was transparent, fully immutable, open source, censorship resistant, permissionless. And so the 2.1 quadrillion units I mentioned in our example actually are the number of Satoshis, the smallest unit of a Bitcoin. So each single Bitcoin is represented by 100 million sats. So there's 2.1 quadrillion sats. And rather than 5 billion units every 10 minutes, 50 Bitcoin were first issued, and then it got cut in half from 50 to 25 to 12.5, 6.25, et cetera, as we approach a supply cap of 21 million. Now, there's two big components to Bitcoin that I think are good for us to understand. There's a public address in the ledger of how much Bitcoin is being held per address. And in order to move that Bitcoin from address to address, if we wanted to spend it or transfer it from wallet to wallet, we need a private key to sign the transaction. Now, this private key is really a long string of letters and numbers, but it can be more easily represented by a series of 12 to 24 words. So if you've ever heard of a hardware wallet, it's essentially like a USB key that encrypts your private key. And you can use this to securely sign transactions to move Bitcoin from wallet to wallet. And when you do that, you actually pay a small transaction fee. So if I was going to send David, 0.05 BTC, I may spend, 0.00001 Bitcoin to have that transaction get confirmed. And those transaction fees that get accumulated every 10 minutes and added to a block get added to this Bitcoin reward every 10 minutes. So over time, as the size of this Bitcoin reward decreases from 50 to 25 to 12.5, et cetera, transaction fees in total will increase as a percentage of the total reward. So this is really the proof of work protocol, just the previous slide. So what I just described is proof of work. It's relying on energy and hardware to validate and secure the entire chain. So what we just maximized here is for having a currency that has maximum uptime and will never go down and isn't resistant to failure. But it makes certain trade-offs. So we're very limited in terms of how much data and programmability we can have in the base layer of the chain. So as a result, new assets and protocols have been created using very similar concepts to Bitcoin, but a little bit more flexibility in terms of what you can program and do on the network. So maybe relying on less number of nodes and more transaction throughput and more flexibility, we could have a fewer number of nodes, but allowing a much more potential options. So what Ethereum achieved is having decentralized applications, open source tokens, smart contracts, and the ability to even trade these ERC20s peer-to-peer. So I'll let Colin take it over from here and dive into more about what you can potentially do on a chain like Ethereum and ERC20 assets and some other protocols as well.
Thanks, John. So for this next segment, I'm going to try and cover it under the umbrella term of Web3. Web3 in some ways is kind of just a fancy rebranding of crypto, but in a way it is an umbrella term that covers a lot of the new innovation that's happening in the space. And I'm going to try and cover a couple of the verticals within that and do kind of a high level overview of them. So first, a quick kind of like definition of Web3. Web3 is the internet owned by the builders and users, orchestrated with tokens. So the key word there is that you own the internet instead of what we're used to, where you're kind of giving that ownership over to the large incumbents like Facebook and Google, and then it's orchestrated with tokens. So it's driven by crypto and what that enables, either in some ways the idea of crypto, in some ways the infrastructure that crypto builds. So within Web3, within that umbrella, I'm going to briefly touch on decentralized finance, or DeFi, non-fungible tokens, or NFTs, as well as decentralized organizations, or DAOs. Next slide. Okay, so one more point on Web3, kind of just give you an idea of what the pitch is on this. Is basically it's a new wave of the internet, either being built in parallel or to partly replace what we're familiar with, which is Web 2. So Web 1, was the original internet, and in its form, it was read only. So you loaded up a browser, people hosted their servers locally, and you could take a look at the websites. You could contribute a little bit through blogs and forums, but it was very much a one-way interaction with the internet. And then Web 2 came along in the mid 2000s, and Web 2 is read and write. So in that way, you could upload content. We are familiar with social media and Facebook, and how basically you built a two-way connection with the internet. But at the same time, you had a lot of big incumbents like Facebook, Amazon, Google that used user data to gain large profits during that time. And in balance against this, Web3 is not only read and write, but own. So when you create things on the internet, or when you invest in things on the internet, you actually do own a part of that. And you can take your data and creations with you from website to website, instead of the website owning it, like when you upload something to Facebook, for example. And I've included two icons here of MetaMask and Rainbow, which are kind of industry standard wallets, which are the new way that people interact with the internet. And that's kind of, so far the past couple of years, acted as almost like your inventory of what you have in crypto and Web3. And moving forward is kind of starting to take form as your digital identity as well. So decentralized finance, at a really high level, it's kind of just the financial services that we've known for a long time being rebuilt on public blockchains. But by doing this removes a lot of the paperwork, removes the third party and rent seekers from the equation. And basically you can get a lot of what you would do in traditional financial services, but with much lower transaction costs. And you could do it 24/7, very low latency, and you can't be, there's very little downtime, that sort of thing. On the right side, I've got kind of a bar graph there showing you the growth of DeFi over the past couple of years. We're using total value locked as a proxy, which is basically the amount of USD that has been locked up as collateral to be used to basically borrow crypto against in the DeFi space. And July 2020 was known as kind of like the DeFi summer, when a lot of these projects started to kick everything off. It was an inflection point, but even then, only $1 billion of value was locked up. And by the end of the summer, it was 4 billion. By early 2021, it was 40 billion. And then by the end of last year, in December 2021, it was 100 billion. And this kind of shows a lot of the institutional capital that was coming to the space, noticing that there was a lot more trust being built, a lot more use cases, and that's kind of what made it take off. I'm going to touch on 3 basic examples of DeFi protocols or projects that kind of helps. I'll keep on the last slide, please. Kind of 3 quick projects that helped kick this off. First is that pink unicorn logo called Uniswap, which is an example of a decentralized exchange. So a lot of people might use Coinbase to trade one token for another, or to purchase a token. Uniswap is one of the early examples of how you could do this on the blockchain and kind of remove the central parties from it. So you can go to Uniswap, sign in with your wallet, and exchange, 100 tokens of token A for the equivalent of token B. And in that process, you pay an exchange fee to Uniswap, and then you pay an additional network fee to use it on Ethereum or wherever you're executing the transaction. And what's interesting about Uniswap is that they don't provide the liquidity that allows the market to be created. You as a user can go and also help create the market by giving 100 tokens token A at the same time as the equivalent of token B as like a pair of tokens to Uniswap, and they'll use that to help people make trades, and in the end you get part of the exchange fee. So it's kind of, you have the two-sided marketplace where it's all run and operated by the users and open sourced. So that's kind of covering an exchange. The gold one there is DAI, which is a stable coin, which was created I think a little bit ahead of the DeFi summer, but really kicked it off in a way that it was one of the first stable coins that was backed by other crypto assets while still maintaining its peg to the US dollar, where its goal is to be $1 or within a certain range of that. And what this did was take a lot of the volatility that people were scared of from crypto and allow you to decrease that volatility while remaining on the network. And then one final project I'll mention is that token with an A on it, that's Aave, which allowed people to lend and borrow against their assets. So instead of having your crypto just sit there, you could loan that to other people or borrow against it in other cryptocurrencies to make use of it. And then, so those are some of the main projects that kind of really kicked off DeFi, are good examples of financial services being rebuilt. And now I'm going to touch on some of the ideas that DeFi brought and that kind of contributed to Web3. So first is that DeFi is composable. Sorry, still on that last slide. First is that DeFi is composable. So if you want to make a new product and within that you wanted to have an exchange component of that, you could interact with Uniswap within that, because the smart contract is on the Ethereum blockchain. And in a way, you can create it like the term people have used, money Legos, where you can kind of take a bunch of pieces that have already been built, recompose it, add your own layer on top of that, and kind of build on the innovation that came before. But by being open source like this also creates forks. So if an exchange like Uniswap isn't acting in the best interest of their users, someone could come along, take their code, rebuild it, customize it, maybe lower the fees, and take some of their market share pretty easily. There is litigation kind of building around this, but it's hard to stop that when your code is already open sourced. And then finally, I think John kind of mentioned this, there are some problems that we're seeing over the past year with how scalable certain blockchains are. So as more and more DeFi was running into the space, and especially as there was a lot of like NFT transactions on Ethereum, that increased the cost to transact on the network. And so we're seeing a lot of new blockchains being built that decide on some sort of trade-off. They might be, less secure, but act faster. I think over the next year or two, we're going to see people making new projects on other blockchains that would be priced out of Ethereum. You couldn't really make them there. So that's kind of decentralized finance at a very high level. Now I'll go on to touching on NFTs, or non-fungible tokens. So NFTs, just kind of boiling it down to a simple idea, is that they are a digital fingerprint pointing to a URL or a file. The reason they're called non-fungible is that, unlike how $1 is equal to $1, and there's no difference between those two, no single NFT is equal to another NFT. Maybe they're an addition or something like that, but it's kind of, they're not fungible between each other. So on the right there, I've taken some artistic license to show what an NFT might look like at a basic level. You have a smart contract that says, hey, this wallet owns this image that's on the internet. And the amazing thing this has done is made the internet ownable in a way that it wasn't before, unless you kind of hosted the servers yourself. But in this case, you don't have to, it can be decentralized. And we've seen a lot of, what could be considered a bubble over the past year or so, with a lot of, money flying into the space and people looking to make a quick buck or two. But there are some fundamental parts of NFTs that make them valuable. One is that you can prove authenticity. So if an artist originally created the NFT, you can trace all the transactions back to who now owns it and who originally created, which can create value there. There's scarcity. So a lot of artists or people who are creating NFTs for a certain purpose aren't going to make a million of them. They might make 50 or 100. And that kind of scarcity, if there is demand, will drive the value up. And then number three, I think most important part that will continue to give value to NFTs is their utility. I think early on, we saw a lot of NFTs as arts and photos, which to some make the argument of how much would you be willing to spend on a painting or something like that. But we're now seeing it being used as game objects. So you could have a character, an item in one game, and transfer it to another game. We also have seen it as access passes. So you could buy an NFT as an access pass, show up to an in-person event, scan a QR code with your wallet that you have on your phone to prove that you own the NFT and be able to get into a live event, or the same idea for online events. And now we're seeing a lot of work being done in the music industry to see how they can build that into NFTs. And then also speaking to that utility, how could you, there's litigation being built around how do you give the IP rights of your art or your music to someone who buys the NFT? How do you help them share in the royalties and kind of share in the upside going forward? So that's kind of a quick run through on NFTs and some of the use cases so far. And now the last thing I'd like to touch on are decentralized autonomous organizations. I have autonomous there in brackets because in practice, a lot of the infrastructure is being built on the fly, and it's not nearly as autonomous, I think, as originally imagined, but they are decentralized, and I think they're one of the most exciting things happening in crypto right now. I like this definition here by Linda Shi. A group organized around a mission that coordinates through a shared set of rules enforced on a blockchain. It's a bit of a mouthful, but the idea is that you can easily organize a group around a mission and enforce and help coordinate that through rules set on the blockchain. So imagine, you and a group of friends want to go out for dinner. Imagine if it was easy to set up like a joint bank account and share, voting on where you're going to go for dinner. I mean, I hope that's not I hope it doesn't have to go to that to decide on dinner, but just as an example. And then, if someone were to host, they'd be given more of a share of the DAO or something like that. So it's basically just, there's a lot of ways you can imagine that you could organize around this, because the blockchain allows you to build trust with others on the internet without having to do a lot of the paperwork or have a third party there. And it creates this design of organizations that are a bit more stakeholder first, because the stakeholders are the shareholders in most cases. So to be a part of a DAO, you typically own their DAO token. You vote on their proposals that go through there. You vote on even people to be promoted within the organization. And when the DAO does well and people want to get in and rise the price up, you share in the upside of that. And I'm going to give a couple more examples of DAOs. I think the original DAOs that we saw a lot of were protocol DAOs. So I mentioned Uniswap earlier, which transitioned to being a DAO. I mentioned the stablecoin DAI, which was created by this green logo here, MakerDAO. And they basically vote on proposals to update the infrastructure and change the fees and everything like that, and kind of run the utility decentralized. There are a lot of investing DAOs. Two fun ones I have examples of here. One is Constitution DAO, which I think made headlines a month or so ago for raising $43 million in a week to try and buy and bid on a copy of the U.S. Constitution. Unfortunately, they did not win. One of the ironies there was that whoever was bidding on the other side knew how much money they had to bid, but it just showed how quickly those network effects can take hold. And another one there in the bottom right, Kraus House DAO, is raising money to try and buy an NBA team, which is maybe the most ridiculous DAO idea I've heard yet, but I can't say that they won't do it. And two more examples there on the bottom left is Gitcoin, which is more organized towards like public goods. They look to build bounties and rewards developers who build things, certain purposes on the blockchain. And then the top right one there is FWB, a DAO that I've been taking part of, which is more of a social DAO. They host parties, help bring creators and musicians as they onboard into the crypto space. And just kind of summing up that DAO area is, it's a way that people are starting to leverage their free time as they give to basically a club or community. They could be rewarded at the same time for the work they put in. So that's kind of a high level view on DAOs, which moving on to the next slide, I'll try and wrap that all up together back into the idea of Web3. Again, with another quote, that the next big thing will start out looking like a toy, which is a quote from Chris Dixon, a famous investor that he wrote an article about this over a decade ago. And I think it's a good framework to look at Web3 and a lot of things that are happening in crypto through, because a lot of it, looks kind of ridiculous, and the early examples of it are quite clunky. But I think it shows a lot of promise, and some of those use cases will be commonplace in a couple of years. So we covered DeFi, which has made money programmable, NFTs, which allow you to own the internet, and DAOs, which basically take network effects and allow you to build new organizations really quickly with strangers on the internet. And now I'll pass it off to David to kind of riff on NFTs and where they're going with the metaverse.
Awesome. Great presentation. Thank you guys for that. Hopefully that transitioned relatively seamlessly back into normal. I had my screen in full screen mode, so hopefully everybody can see and hear me okay. But yeah, great things touched upon there, a lot for people to think about. I also see a ton of awesome questions on the right-hand side, so I'm definitely going to look through those as we progress to the final Q&A portion of this talk. But yeah, I just made a couple notes as people were talking. I think there's a lot of really interesting things I can touch on, but I'll just touch on a few. Maybe just to start, Colin was talking a lot about DAOs, and I have the pleasure of working with a couple DAOs. I work for a couple DAOs. I'm in a few DAOs. And when you think about where we're at in terms of that space, really the ethos here is not about trying to get more control. It's about owning your control of something. So instead of being, instead of a company having a CEO, nowadays a company will want to have, or a DeFi or a Web3 company might want to have a DAO instead of that specific CEO, because they want to, distribute that ownership or distribute that responsibility over a series of stakeholders or people who are financially invested in that project. So actually just one little thing I wanted to mention is that one of the companies I work for, these terms are all new and they're all changing. So one of the companies I work for is now calling themselves a LAO, or a leaderless autonomous organization, because they really want to push the idea that there is no single person in charge of that organization. So I think that's just an interesting notion to think about when you're seeing how this space is evolving, every year and moving forwards. So Colin touched on a lot of, the key parts about, NFTs. So I won't go into too much, 1 Bitcoin equals 1 Bitcoin, 1 Ethereum equals 1 Ethereum. 1 NFT does not equal 1 NFT. They're all completely they're non-fungible. There's no, exact value based apart from what value is prescribed to that object. So, really key elements for me around NFTs. For me, the top 2 things are really provenance, ownership, and I said 2, but I'm going to say 3: provenance, ownership, and royalties. Because previously, there are a ton of different models in the entertainment industry where people could make money. You could have, but usually those required some kind of a third party, or an agency or a management. And that's a very Web2 mentality. Having to have something in control of you being able to make your finances. That's a very Web2 mentality. So the Web3 mentality is to have direct control, to be in direct communication with your community, and to ultimately have self-sovereignty. So one of the notes that I made that I just wanted to touch on when you're thinking of this shift to Web3 is really the shift towards data sovereignty. So up until this point, we've been giving away our data for free. And one of my dearest friends, who's also one of the metaverse editors at Vogue Singapore, Krista Kim, she talks about how if every single person who has a Facebook account was actually compensated monetarily every time their data was sold, that would erase a ton of poverty that currently exists in the world. So this sounds like just like a, an idealist notion, moving from one version of the internet to another version of the internet. But this version of the internet is, personal opinion, a superior version of the internet, where people actually have control over their data, and they have full control to see how anything is happening in terms of their finances, in terms of their identification, in terms of what data of theirs they've, put out on the internet or put out into the ether. And I think that's really important. So I made the note of provenance and royalties, but then also I made the note of, Within this realm of data sovereignty, also something really important to mention, if anybody's looking to explore this, obviously no financial advice, but this is the one piece of advice I will give you is do your own research. We can tell you about Bitcoin and Ethereum and NFTs and these kinds of, verticals, but ultimately, all the information is out there on the internet or on the blockchain. Any transaction that has ever been made on the blockchain, you can go back and check yourself. People always talk about who is Satoshi Nakamoto, who started Bitcoin. Could it be a scam? Well, you can go see for yourself if you want to get, a knowledge around blockchain and a knowledge around coding that'll allow you to understand everything that's going on. If you look at a smart contract, or if you look at, hashes, then you can actually go yourself. You don't have to trust, you verify via code, trust in code, not people. So I think it's a really interesting notion, and it's kind of like a mindset shift that we're going through. And that all kind of leads for me to wrap up on the idea of the metaverse. So another lovely thing, I actually wrote it down because I really liked it, that Colin mentioned that the next big thing will start looking like a toy. And I think that's a really smart way to think about, as we move into this metaverse or into this metaverse space. A lot of people have been talking about this with Zuckerberg and everything, but I think ultimately when you think about it, what Zuckerberg is trying to build is not a metaverse in the Web3 sense of a metaverse, unfortunately. And no offense to anybody here who might work at Facebook or anything. From the NFT perspective, what they're building is, a virtual world that they would ultimately, hopefully have control, from their perspective, hopefully, have control over. And, a metaverse in the state, in the way that Web3 folks will think about it, there's a bunch of theses written around the idea of the open metaverse or the omniverse. So what we're trying to move towards in terms of a virtual world or the future of the internet is a space that is not controlled by one single entity, but a space that is interoperable, is a space that is, that allows people to be sovereign beings and control their own data. So when you look at, companies like Decentraland, who I work for, they're one of the largest currently existing metaverses. They have almost 1 million active users in their metaverse, but when they're doing events, they're not trying to keep everybody in. They're trying to facilitate this idea of the open metaverse. They're allowing people to go to other metaverse solutions, other verses, as people call them in the space, because from our perspective, there is no one true metaverse, because one true metaverse would be, omnipresent and would take over the entire system. So I think it's an interesting thing as we're moving towards this. And when you're thinking about the metaverse, to go back to Colin's quote, you think about a video game, because it's the only thing that we can equate to what we're seeing in front of us when we're seeing a virtual world with three-dimensionality and interactive elements. The closest thing we can equate that to is a video game. So you hear people a lot in this space talking about gamification. And I feel like that really, really relates to what you were saying, Colin, about the next big thing is going to look like a toy. So if anybody here is brand new to the metaverse, I don't ask you to spend any money or do anything. All that I ask, if you're interested in trying to figure out your next steps and what this all is, go to Decentraland, sign up for an account. It's free. I can type it in the chat here, just Decentraland, just so people, in case anybody doesn't know. Decentraland. If you want to just Google this and pull it up in your browser afterwards, you can use it on any computer. And if you go through what they have, it's called the Genesis Plaza. So if you jump down through this little waterfall and you just run around this like little opening village per se, it'll give you a ton of information about how they started and what this space is. And what you'll very quickly realize is that each building in this space is not a building like you would see in a video game. Each building is like a website. Each building is a more gamified, more immersive version of a website that you can go into, and instead of reading data, you'll go over and you'll speak to a robot, and that robot will tell you the data that would usually be just written on a website. So it's a more engaging, more gamified, more immersive version of the internet. So, as we're moving from the internet to blockchain, and now through the facilitation of blockchain to this idea of the metaverse, we're just building upon what currently exists. And, the last thing I'll touch on, because it's always a thought, when you're dealing with this, if this all seems overwhelming to you and it's like, how did this all happen? I swear we were just, getting on Instagram, a couple of years ago. That's fair, because of I always like to touch on the concept of hypermodernization. Hypermodernization is a term that we have reached a point technologically as a society that it's difficult for us to comprehend how fast things are growing. So at the turn of the Industrial Revolution, you saw somebody driving a car. You can imagine that one day that car might have wings and could fly. I don't know, just as a hypothesis, an imaginary idea. So eventually that could happen. But when you're moving into the space of Web3 and things are moving super fast, when you just wrap your head around the blockchain, and now you have to wrap your head around the metaverse, and it's something that has developed, within the past. There have been theories about the metaverse since the 70s and 80s with certain books like Snow Crasher, but in terms of actual practice, I mean, VR and AR have come about, in the last 10, 20 years, and they're only really coming into any kind of, high fidelity system now. So it's a very, very current new thing. So I'd say don't be scared of this whole space. Look at it as, you know, a new horizon, as a new place to explore. You know, the future explorers of space are not going to be on this planet. They're going to be virtual explorers. They're going to be looking through the metaverse. They're going to be building and growing and creating spaces and communities that have never existed before. And I know I said the last thing, but this is the last thing I'll say because I do want to be conscious of time and I want to make sure we have time for questions. But when you're thinking about NFTs, I know this is also another thing that's come about as a buzzword. And this is the space that I primarily work in. So I always like to just say this one thing about NFTs. NFT, like non-fungible token, is a buzzword. You know, it's just the current manifestation of people using blockchain effectively, using you know, blockchains like Ethereum and other blockchains effectively. And this is just the very beginning. You know, last year in November, the current running statistic was that 0.0009% of internet users own an NFT. So that's 3x since last November already. So now it's whatever 3x that would be. But it's still a very small percentage of the world. So this buzzword, this terminology is not really coming into effect in terms of how many people are adopting it. The people who are adopting it really hardcore. You know, there's a lot of people out of that, you know, small percentage of the internet who own hundreds, if not thousands of NFTs. Because when you start thinking of NFTs, not just as a piece of art on the blockchain, but you start thinking of it as tokenized utility, that's when you can really start thinking further. And I think that, yeah, Colin already mentioned a bunch of the examples, but, you know, in the future, our concert tickets are going to be NFTs, not because it's a fun, cool thing, because it's an easier way to transact and, you know, move data in a public facing way that's on the blockchain. You know, any transaction that is made, you can then check up upon anybody, a bank, a government, an organization. So for all the arguments of people saying that, you know, blockchain is, you know, a shadier way of doing business or a less transparent way of doing business, it's unfortunately just incorrect, because if people understand the blockchain, they'll understand that, you know, any transaction that is made is out there for people to see. So anyway, that's just the last thing I wanted to touch on. You know, NFTs are kind of just this future vehicle of, you know, decentralized finance transactions. And yeah, I hope that this made some sense, and hopefully now we can get over some questions. I'm just going to scroll down in our notes. And yeah, so I think that we can transition this over to questions. So maybe right up first, I'm just going to look through these. Maybe in the meantime, I don't know if John or Colin had any other final thoughts that they wanted to add on to what I just said before we hop on over to questions, but yeah, we can do that now. Okay, if not, then we can just hop on over to these questions.
Yeah, I think there's a lot of good questions in the chat.
Yeah, so we have one from Maxime, class of 18, and their question was just trying to understand how feasible it is that the central banks would allow the use of Bitcoin or a similar crypto, and how it would impact the banks in general. John or Colin, do you?
Yeah, I'm happy to take that one. So the great thing about Bitcoin and these assets in general is that they're permissionless, so they don't require central bank approval. And it's been around long enough and distributed wide enough that it's really economically infeasible to try to attack or control. Even if you deploy a ton of capital or really strict regulations, because of game theory, it's in each individual country's best interest to craft favorable legislation that embraces the technology as opposed to constrict it. We've seen countries that embrace it experience a wide flow of investments and an increase in GDP. So I think that alone provides a very strong incentive to have open arms to the technology. And I saw another question that that references central bank digital currencies, CBDCs, as well as gold-backed currencies, and how those could potentially challenge Bitcoin or these crypto assets. So the issue with the CBDC is that you ultimately have the same problem with fiat currency debasement today. You still have debt, and you still have this issue to print more currency to service that debt. So even if it's in a form of a digital asset, you still have an uncapped supply. And as a holder of that currency, you're at risk of losing purchasing power over time. So I think that that's the major difference between the two. And then with gold, you still have counterparty risk. That gold has to be in a vault somewhere. And it's really tough to audit who has claims to that gold. Whereas with digitally native assets like Bitcoin and Ethereum, you can verify with 100% certainty where assets are and how they're being held. And you can even take it one step further with multi-signature wallets, where you can have private keys geographically dispersed around the world that need to come together, not physically, but need to sign a transaction in order for that Bitcoin to move. So rather than having valuable assets in a vault somewhere in one physical location, we could have USB keys split across the entire world to custody billions of dollars worth of assets. So it eliminates having a single administrator with the keys to the kingdom. You can really assign, who has the right keys and how many keys are needed for assets to move on the blockchain.
Awesome. Awesome. Hopefully that answered your question. I see another question here that I think piggybacks off of that really well in terms of like structure/ownership. So this is from Owen Gaffney. He says, doesn't the structure of a DAO exacerbate issues created by the lack of accountability with a decentralized ownership and leadership structure? Who is ultimately responsible for example, any malfeasance on a DAO's part? Colin, do you want to pick up on that? And then maybe I can also piggyback.
Yeah, I think it's a good question, and something that I think is being worked on a lot. There's, the legal side of it, I'm not too familiar with. I know that I think Wyoming has created a lot of legal infrastructure in the United States to allow DAOs to start to become legal entities as well. I know on the back end, a lot of them are doing that so that you can hold those assets, pay taxes on it, and kind of do a lot of the treasury management there. And a lot of DAOs sit there with gigantic treasuries as kind of collateral in the case that this happens. I haven't seen many examples that have kind of shown a lot of malfeasance and how that has played out. But at the end of the day, if a DAO acts in a bad way, you can kind of trace back who controls those decisions, because everything again is kind of encoded in the blockchain. Whoever voted on X, Y, and Z wasn't able to, or basically has to hold to their decision. And then also a DAO is usually moving closer and closer towards all the tools are basically, not one person has access to the bank account. There's a lot of work going around where people who put a lot of thought into how do you build new cities and communities are now applying that to DAOs, about creating mission statements and kind of rebuilding a lot of the same ideas that we've had with traditional organizations. Yeah, I think that's my main response to that, and I think it makes me think about, I think, another debate that's going on right now between the back and forth between decentralization and centralization. But first, I'll pass it back to David if he has some thoughts on the DAO question.
Yeah, no, great insights. I think it's interesting when you consider if the DAO is running a company, or if it's more of what I call like a CDFI situation, or a centralized, decentralized finance situation, just because of course we need more acronyms in this space. But yeah, when a company is run by a DAO, or it's a DAO run company, I do think, and I work for one of the media companies I work for, WTF, is founded by a venture capital fund, but they created a DAO to run this media company. So essentially all of the people who've invested in this company are board members or DAO members, and they all have the right to vote. They have equal rights to vote on any decision. So we actually found that out of the 100 or so people in this DAO, we were getting maybe like 30 to 40% voting, which, they have the right to do whatever they want. Everybody's a sovereign being. They can, respond however they'd like. But the way that we remedied that, and the way that I've seen some organizations remedy that, is by electing. So it is all, electoral. So everybody does have a say, electing an advisory board. So in our case, we have an advisory 10. So we used a program called Snapshot, which a lot of different DAOs use. And they voted on, 10 people to make key decisions. So now when we're going and we're trying to get a vote, we just have to get a majority out of those 10 people. And then we also run that decision by the general DAO. If they don't have a problem with it, we move forwards. That being said, there are also companies, so existing centralized companies, that do also have DAO mechanics built into them. So they've started a DAO in order to vote on key decisions for their companies. So organizations like Decentraland, organizations like Rarible. Rarible is actually one that I mentioned because I think this is an evolution on these kinds of DeFi mechanics that we're seeing coming through NFTFi companies or NFT companies. But yeah, you have certain companies where the DAO mechanics are really just to allow community members or stakeholders or investors in their coin, most specifically, to be able to vote on things that are happening. So for instance, Decentraland might say, somebody just applied to join our wearables market. They need to get, a general consensus of, yes, these people should join our wearables market or not. And they've chose kind of key decisions in their organization. Since they are a decentralized organization and they're a non-for-profit, they've decided to go that route in terms of voting on key decisions. So anyway, I think it's fairly flexible. But to answer your question, yes, there are instances, especially in very small DAOs, where there are issues in terms of governance and who's going to lead and who's going to decide. But generally speaking, I will say that especially in terms of most of the companies that have started DAOs in the space, they have mechanics built in to allow for human error, if that makes sense. So yeah, hopefully that answered your question. I see Brendan hopping back on, so I know that means we're wrapping up towards the end of our time, but maybe we can squeeze in one or two more questions if that's all right. Okay, excellent. I did want to get to another one that was written here. I believe this is from Samantha, but I liked it. So one of the biggest benefits of cryptocurrencies is that they do not involve financial institution intermediaries. In your opinion, what are other top benefits? Are these the benefits that are currently disrupting the financial services industry? John or Colin, would either of you like to answer that one?
Yeah, so I think, while it is very disruptive technology, it still can be embraced by the traditional financial institutions we have today. There are still services in terms of converting fiat to digital assets, the on and off ramps that exchanges are currently providing, that banks could play their role in. And they can also help with custody, because maybe users don't want to manage their own hardware wallets and protect a private key. They could have it in an insured bank account once the banks are ready. So these are assets that the banks could embrace and adopt. And I suspect the ones that do first will probably reap the rewards of being early. So I think there is a world where they can come together, though it does really challenge the liquidity and availability of capital. Because it puts a lot more pressure to be accountable to the assets you are holding. We've seen over the years a lot of volatility and fluctuations in price because this transition won't happen overnight, right? This is a very long path that requires a lot of investment and security features to transition, the fiat currencies to digital assets. So while you may see the price fluctuate, up to $20,000 down to $3,000, up to $60,000 down to $30,000, et cetera, I think if you come at it from a much longer term time horizon, not looking to make a quick buck in and out, and look at a 5 to 10 year horizon or longer, it's a lot more palatable, and with capital that you're willing to park for a longer time. So not financial advice, but I think that that's a good way to approach it. I saw one other question refer to that as, not asking for financial advice, but what would you do? And so if I had, let's say an inheritance and I was given a bunch of money and I had to put it to work, if there was one asset I could own, it would be Bitcoin. If there was two, it'd be Bitcoin and ETH. And I have a lot of confidence personally in those two assets after spending the years that I have. But I'll open it up to the panel to let them share their thoughts as well.
I think, yeah, maybe I'll add one on the kind of top benefits that I think for basically crypto. And for me, I heard it described this way where basically think of crypto as lowering the cost of network effects. So if you think of, the internet made the cost of sending information much cheaper. Artificial intelligence is making the cost of prediction a lot cheaper. And I think crypto is making network effects a lot cheaper. And if you think in that context, as a benefit, and try and imagine what could you do if you had an idea and then you could get everybody around that was interested in the idea anywhere across the world to take part in that, what kind of new business models would come out of it? So to me, that's my favorite way of thinking of the top benefit of crypto.
Awesome. Awesome. Great insights. Appreciate you both. I'm gonna wrap this up and answer a question in the process, if that's all right. I have to agree, first of all, with John. When you look at what, cryptos to invest in, of course, no financial advice. You really want to look at what backbone type cryptocurrencies or, blockchains are supporting this entire ecosystem. So that's all I'll say on that front. But yeah, just to quickly answer a question as I wrap this up. It was a metaverse question, so I'm happy to just quickly answer this one because I think it's interesting. Somebody asked, Jamie Brenzel asked, are there opportunities to build businesses by owning NFTs within a play to earn game metaverse? So I just want to quickly cite a couple examples. First of all, there are several different companies who are starting businesses within virtual spaces, within metaverses, such as The Sandbox and Decentraland. There are companies like Decentral Games, which started a casino format in Decentraland. And they charge companies between $20,000 and $60,000 to build them a casino, and they also take a percentage of all profits. So they're doing very well. So that's an example of one company that just started, its own in a metaverse. And additionally, always the lovely example that we like to source or cite right now in the space is Axie Infinity. Axie Infinity is a play-to-earn game. Jiho, one of the founders of that, is actually in my DAO, so I've gotten to talk to him a bit about that game. But again, without going into too much detail, that is a game where you can buy NFT characters who you can play in this game and earn an income doing that. And there have been reports and news stories of people in the Philippines who have made beyond full-time incomes, doing this game or playing this game. So yeah, the future there is very bright. And I'll use that as my catalyst to start wrapping this up. So of course, this is a rapidly evolving space on all fronts: development, investment, regulatory, and trading. All the areas surrounding cryptocurrency, trading, execution, custody will continue to become more efficient, less expensive, and safer as the market matures and more institutional players get involved. Governments are considering additional rules, regulations, and disclosures for consistent identity collection, reducing illegal activity and tax collection. There is still no consensus about the best use case and even what that is. And for now, that's okay. Ultimately, the stakeholders and marketplace will determine the next decade of cryptocurrency. So yeah, just want to thank my fellow speakers today, John and Colin, for all of their insights today. I appreciate everybody taking the time out of their day to listen to us, babble on about our favorite topic. Yeah, I would love to pass it back over to Brendan to wrap us up. Thank you very much.
Thank you very much, David. On behalf of all of us who have been riveted by this conversation, thank you, to John, to Colin, for sharing your expertise and perspective. Clearly, not only are these ideas philosophically compelling, but the artistic and the economic opportunities presented are just extraordinary. My deepest thanks as well to all of our attendees. It's great to see so many alumni, parents, colleagues, and students on this call, and phenomenal to see the back and forth engaged in the chat, questions, opinions being shared. This series is all about community connections, diverse perspectives, innovation, and learning. And thank you for making this such an extraordinary event. If you enjoyed today's presentation, you're going to love what's next in the Speaking Of series. Next week, we'll be speaking of environmental sustainability, followed in subsequent weeks by conversations about Canadian diplomacy and dynamic communications. So please keep your eye on your inbox for registration links and reminders. And if you really like today's presentation, you can show your support for UCC's mission to provide transformational learning with a charitable donation to the UCC Annual Fund. Those donations enable us to support our students through investments in technology, well-being supports, and financial assistance. Every gift is meaningful and can be easily made online at ucc.on.ca/giving. Sorry, we don't accept cryptocurrency yet, but maybe one day. With that, let me say a huge thank you to all of our panelists, to all of our attendees, and to our advancement team for their crucial support of today's event. Our panelists have graciously agreed to stay on to answer any questions that were burning and didn't have an opportunity to be answered. So if you would like to remain online to ask a question, please feel free to do so. With that, thank you. Enjoy the rest of your afternoon. Stay safe, and we hope to see you again soon. Take care.